Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim, as you know, is an investment banker and investment advisor based in New York. He also serves on the Investment Advisory Committee for the Physical Gold Fund. Jim Rickards is the author of the New York Times bestseller, Currency Wars, The Making of the Next Global Crisis. And most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Hello, Jim, and welcome.
Hi, John. Thank you. Great to be with you and great to be on the call.
We also have with us Alex Stanzik of the Physical Gold Fund. Hello, Alex.
Hi, John. Great to be here. Thank you.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. I should today emphasize as time allows, because on this occasion there's an awful lot of ground to cover in one conversation, as we'll see. Well, Jim, we last spoke on January 12th. Let's take a look at what's happened in 4 short weeks since then. First, the Swiss Central Bank decoupled the Swiss franc from the euro. The Greek electorate drew up battle lines with the European powers that be. The European Central Bank announced a massive money printing bonanza. And sadly, Ukraine edged closer to a major conflagration. So in a moment, let's take these one by one. But first, at the macro level, Jim, what's up with Europe?
Well, it's a great question, John, and you're absolutely right. I mean, I've enjoyed all of these webinars in the series, but of all the ones we've done, I think this is the one with the biggest agenda, the longest list of not just headline-making events. I think a lot of the listeners are aware of those, but what is the meaning of them, and more importantly, I think to your question, how do they connect? If I look at what's going on in Europe, and whether it's Switzerland, Greece, ECB, Ukraine, Russia, all the issues you mentioned and some more, to me the common denominator is the lack of U.S. leadership. I mean, a quick glance at the history of Europe for the past 2,000 years shows that it's divided, it's warring, it's numerous ethnicities, numerous cultures, even multiple civilizations. If you want to look at the the Eastern Orthodox and the Western Catholics, I mean, there's just a lot of ways to divide Europe. But the history of Europe is warfare, bloodshed, and division up until the end of World War II. And then the end of World War II, coming so soon after World War I, was such a disaster. Europe was so exhausted that it was really the U.S. creating a new world order using a combination of NATO, the United Nations, the Bretton Woods agreements, International Monetary Fund, the original gold standard coming out of Bretton Woods, the Marshall Plan. There were a whole host of things, but they all had one thing in common, which is U.S. leadership, and U.S. has provided that leadership ever since. Now, Europe's come a long way. Obviously, the European Union is a very significant development, going back to a series of treaties from the 1950s, and then the launch of the euro in 1999, and the actual use of euro currency in 2000. So Europe has done quite a bit on its own, but the minute the U.S. is absent, the minute U.S. leadership is lacking, guess what? Europe goes back to its old mode of internal squabbling. We saw a little bit of this in the 90s with the Bosnian genocide, when the Clinton administration was very slow to get involved, and it was only when the Clinton administration did get involved, led by Richard Holbrooke and others, that that crisis was resolved. So if you ask me to, we're going to take these one by one and talk about them in an economic context, but if you ask me to give a sort of a single global macro overview of what's going on in Europe, I would say that U.S. leadership is missing. Whenever U.S. leadership is missing, Europe reverts to what Europe always does, which is a lot of squabbling and with a lot of potential for war, and so that's what we're seeing.
Well, that gives a very, very interesting and helpful context. Thanks. So let's focus in on Switzerland first for a moment. So on January 15th, the central bank ambushed us all with a decision to decouple the Swiss franc from the euro. And there was a sort of brief chaos in the currency markets, but it seems like everyone has returned to business as usual. Can you help us understand the decision, and are there any lasting implications that we should watch out for?
Well, the timing of the decision was certainly a surprise, caught everybody off guard, including Christine Lagarde, who's the head of the IMF. She gave a very interesting interview on CNBC around that time. I think she was in Davos, and so normally she would have been someone that they interviewed in Davos, but it happened to be the day that the Swiss broke the peg to the euro, and she was very visibly perturbed, visibly angry, upset, and clearly had not been consulted. So, yeah, it's a shock when you break a major currency peg between two major reserve currencies, and no one has the presence of mind to call the IMF and give her a heads up. But so, yeah, the timing was a surprise, but the breaking of the peg was not a surprise. And the reason I say that is, whenever you have a non-sustainable policy, the one thing you can be certain of is that it won't be sustained. In other words, you may not know when it breaks, you may not know the exact consequences of the break, but you can be sure it'll break, because if you have to have a peg, it means you're fighting market forces to begin with. Why would you, if the market was going the way you want it, why would you need a peg? Well, you wouldn't. If you have a peg, it means you're fighting the market. Well, markets are always bigger than you are, even for a major central bank. And what was happening was that in order to maintain the peg, I mean, remember how this worked mechanically. Everybody wanted Swiss francs because it seemed like a good store value. People were dumping euros because they were worried that the euro was going to fall apart, or European economy was collapsing. Of course, some of those worries have only been exacerbated by what's going on in Greece. So you had a very simple trade. People wanted to dump euros and buy Swiss francs. Well, if you left market forces to work, the result would be that the Swiss franc would trade up and the euro would trade down, and that's pretty simple. But Switzerland didn't want that, and that's because they have a highly export-dependent economy. You know, they make, we're all familiar with, you know, chocolates and dairy goods and cheeses, but of course they make watches and precision machinery and pharmaceuticals, and they have a lot of other high-tech, high-value-added exports. And then you can think of tourism as a kind of export. I mean, the mountains they don't ship the mountains to California, but Californians get on a plane and go there to go skiing, and so that's a kind of export, all very sensitive to exchange rates. If the Swiss franc gets too strong and I want a European ski vacation, I can maybe go to France or Austria instead of going to Switzerland. So that's why they wanted to keep the Swiss franc from appreciating or going up too much, but the market wanted it to go up because they wanted Swiss francs. So in order to maintain the peg, they had to print Swiss francs, use them to buy euros. Then they took the euros, they bought them at the pegged rate. That's how they maintained the peg. Then they took the euros and went out and bought euro securities, euro sovereign bonds and other euro-denominated securities. Well, guess what was happening? They were inflating their balance sheet. They were piling up massive amounts of euro securities on the balance sheet of the Swiss National Bank, flooding the market with Swiss francs. And if they didn't break the peg, they were going to end up owning every euro in the world, because the point is the pressure never let up. That no matter what they said, no matter what they did, the market still wanted Swiss francs. And so they were just going to blow up their balance sheet, as I say, owned every euro in the world. So it was clearly non-sustainable. They picked a particular moment to break the peg because they knew, you know, maybe no one called Christine Lagarde at the IMF, but it sure sounds like Draghi and the head of the Swiss National Bank were talking, because this happened literally days before the ECB announced their quantitative easing. So it was almost as if to say, well, okay, you know, Switzerland, we've done our part to prop up the euro. Now over to you, you know, European Central Bank, and it's your job. So the reason they broke the peg was because they had to sooner or later, because it was non-sustainable. The lesson for markets, by the way, is look around the world and find anything that looks like a peg. And the one that comes to mind, of course, is Hong Kong dollars to U.S. dollars. I'm not saying that Hong Kong is going to break the peg tomorrow, but whenever you have any currency that's fighting the market, it's probably just a matter of time before the market wins. So whenever you see, you know, any relationship like that, or any effort to rig a market, whether it's the Fed and interest rates or any pair of exchange rates, it's probably going to break down sooner or later. And usually when it does, there's a shock factor, because people aren't ready for it. So that's why they did it. It was bound to happen. The timing was a surprise, but the event itself was not a surprise. I think the lesson for investors is whenever you see any sort of artificial peg like that, of course the big one right now, there is another one in play, which is Denmark. Denmark has cut interest rates 4 times in the past couple of weeks in order to try to cheapen their currency, because people are flooding into Danish capital markets right now trying to get the Danish krona. So it's very easy to predict that will break at some point. They're going to let the krona go up, but for now they're still fighting it. So that's another one to watch.
Excitement about the Swiss move was pushed aside by the next announcement that you mentioned, the European Central Bank launching a huge asset buying program. Now, in the past, you've emphasized in discussing this possibility the difference between the ECB and the Federal Reserve. So I'm curious to know if you were surprised by this decision, and beyond that, Will it work?
Well, two different questions, of course. Now, this was about the most well-advertised easing program you can think of. I mean, if you go all the way back, when did Draghi say whatever it takes? The euro was under attack, the Eurozone was under attack, and he needed to calm down markets, and he said, we will do whatever it takes to defend the euro, and believe me, it will be enough. Those were his exact words. Well, guess what? He said that in the summer of 2012. So the fact that it took, almost 2.5 years to actually do something, like I say, it was pretty well advertised. At the end of the day, they probably did have to do something. Now, one of the important ways to understand this is that so many Western analysts, and I say Western, I really mean the United States and UK, look at Europe and think this is a stimulus program similar to what the U.S. has done. Well, I have news for them. Number one, quantitative easing doesn't stimulate anything. It does have effects. It does have channel effects in terms of creating asset bubbles. It does have potential channel effects in terms of exchange rates, but it doesn't create jobs. It doesn't stimulate anything. So that's nonsense, and Draghi knows it's nonsense. So they're not doing this for the so-called stimulus reasons that the U.S. supposedly did it. They're doing this to fight deflation. They don't have a mandate. The European Central Bank does not have a mandate to create jobs and stimulate the economy the way the Fed does with the Fed's dual mandate. They do have a mandate to maintain price stability. And the prompt for this was deflation. Deflation is not price stability. Inflation is not price stability, but neither is deflation. Whenever you are whether increasing or decreasing the purchasing power of your currency, by definition, you don't have price stability. So that was really what prompted it, not any kind of stimulus program. That's important because it means that they won't go beyond what they need to maintain price stability. If you see the deflation start to level off in Europe, and I think we're already seeing some signs of that, and you see them getting into a little bit of inflation rather than deflation, what that signals is that Draghi will not be doing much more. Whereas in the U.S., we think, you should have QE1, QE2, QE3, multiple rounds, keep doing it until you wipe out unemployment and, create nominal growth. Draghi doesn't believe in any of that. But he does believe in price stability, and so they'll do enough to avoid deflation, but not more than that. So that's number one. So even though it's now happened in terms of what's going to happen in the future, I wouldn't expect a lot more, number one. Number two, there's less here than meets the eye. A lot of this so-called quantitative easing, first of all, it was once again, I mean, I love Draghi because he's the master of saying little and doing less is the way I put it. So they had this announcement in January. They haven't actually started the program yet. It's supposed to start in March, so it's still a few weeks away in terms of the launch. So again, this is still vaporware. But beyond that, a lot of these purchases are going to be from what they call the NCBs, or the national central banks, rather than the European Central Bank itself. I think it's important because, in the U.S. we have one Federal Reserve system. Now, there are 12 regional Federal Reserve banks, but they're all under the thumb of the Board of Governors and the FOMC in Washington, and they don't really act very independently, at least not in terms of monetary policy. But in Europe, you do have the European Central Bank, but none of these national central banks went away. I mean, there's still a Central Bank of Greece, there's a Bank of Italy, there's the Deutsche Bundesbank, which is the Central Bank of Germany, Banque de France, the Central Bank of France. All these central banks still exist, and what Draghi said is that you central banks have to go buy these bonds. So you're going to see, the Deutsche Bundesbank buying German bonds, and the Greek central bank buying Greek bonds. Good luck with that. But a lot of this has been pushed down to the national central banks, and that's important for credit risk reasons, which is that if those bonds go bad or are devalued or restructured, those losses are going to fall not on the ECB balance sheets of the national central banks. So again, even in terms of the ECB, there's less here than meets the eye. And finally, one of the big trends of the past 2 years was that the European Central Bank was reducing its balance sheet. They were some of the ease that they put into the marketplace in 2012 and 2013, some of those asset purchases were actually being unwound during the course of 2014. Unlike the Fed, which blew up its balance sheet and never looked back, the Fed has tapered additional long-term asset purchases, but they haven't done much, actually very, very little in terms of reducing their balance sheet. Their balance sheet is still at a very high level, a very inflated level. The ECB actually did. And so to some extent, this quantitative easing is just putting back some of the easing that they took away in 2014. So on net, the balance sheet isn't any bigger than it was in 2013. So putting all this together, the fact that they're only doing enough to avoid deflation, it's not really a stimulus program. The heavy lifting is being pushed down to the national central banks, and all they're doing is putting back some of the money that they took away last year. To me, this is a big nothing burger. I wouldn't get too excited about it. It does have one effect, one very important effect, however, which it has helped to keep the euro low. The euro traded down from about a high of 160. Recent years it's been around 140. It traded down through 120, which is where it was in the crisis, all the way down to about 113. I think it is close to a bottom at that level. I'm not saying it couldn't go down a little more. Probably would tick down a little bit as we see some bad days, bad headlines coming out of the Greece crisis, and we'll talk about Greece in a minute. So I'm not saying it can't go lower, but it does feel it's near a bottom. But I think the ECB program was putting the icing on the cake. One other thing, by the way, a lot of the easing already took place courtesy of our friends the Swiss. Go back to what I said earlier, before they broke the peg in January, but before they broke the peg, they were printing francs to buy euros and then taking the euros and buying euro securities. Well, guess what? That was a form of easing because they were that's just a different central bank. It wasn't coming from the ECB, it was coming from the Swiss National Bank. So a lot of the easing was already in the marketplace, and the ECB is just sort of not really doing a lot more, but keeping a lid on it and keeping the euro where it is. So we'll see the euro at these levels at least until later this year. If there's a reversal, it'll be not because wonderful things are happening in Europe, but because the Fed wakes up and realizes that they're not going to be able to raise rates, although that's a separate discussion. So the big takeaway is, this is keeping the euro at a weak level. I don't expect a lot of stimulus, but it is another example of the currency wars.
Well, you mentioned the next shock to the European system, which arrived on January 25th, with the election in Greece of the left-wing Syriza party, and this put Greece on a collision course with the so-called Troika, the European Commission, the European Central Bank, and the IMF on the issue of sovereign debt. How will this one play out?
Well, I think it's going to play out the way it has played out before, and I have a long history with this subject, as you know, John, going back to my first book, Currency Wars, in 2011, and a series of interviews I've done ever since, but we're really talking about 3.5 years at this point, even a little bit longer, going back to 2010. I've been, at the time, the only voice, and even now one of the few voices who have been of the view that Greece is not leaving the euro, Greece is not being kicked out of the euro. The euro as a system will add members as it has in recent years, and isn't going anywhere. I call it the Hotel California. You can check in, but you can't check out. I continue to be of that view. I've been pouring cold water on the Grexit. Now, the Grexit voices, you heard Rubini and Krugman and Stiglitz and Zero Hedge and all these guys in 2012 saying, Greece was going to get kicked out, Spain was going to quit, and Italy was going to quit, and they were all going to go back to their local currencies and devalue and lower their unit labor costs, and that was going to be the antidote to austerity and all that. And I said at the time that was nonsense, and I said that again in my second book, The Death of Money, and I've been consistently of that view, and I remain of that view. In other words, there's not going to be a Grexit. Now, having said that, let's not underestimate the seriousness of the situation. We do have a political party that has staked out some very tough ground, which is new. That the political parties that were in charge up until now favored working with the Troika, and now you have a political party that is leading a government that wants to confront the Troika. So that's new, and that's riskier, and that's a more dangerous situation, and that's going to grab some headlines, and that's going to make a lot of people nervous. So I recognize that we have a new political reality on the ground, but I still am of the view that Greece is not leaving the euro, and here's the basis for that. To me, look at this. This is not different rather than any other negotiation I've ever been in. I've done a lot of negotiations over 40 years. I've certainly been in capital markets and banking markets the whole time, but I've also been a lawyer and done quite a few deals. And prior to going into a room and closing the doors and sitting down and banging through the negotiation itself, there's a lot of posturing and positioning, and even when the doors are closed, you start out that way, and then you start to reach for common ground. So right now, These negotiations have not begun in earnest. They will shortly. The two sides have been huddling on their own, so we have speeches from the Prime Minister of Greece and interviews from the Finance Minister, the European major countries, major participants in the European Central Bank. They've been meeting on their own in Brussels, working out their position. Everyone's got their press releases out and everyone's posturing. So now we know what the two sides are, and the lines are more starkly drawn. They are confrontational. But here's how to understand the negotiation dynamic. You have to say to yourself, well, what do I have to gain or lose by reaching some kind of agreement or some kind of compromise, and what do I have to gain or lose by walking away from the table? And this is a classic negative-sum game. You have to put the behavior, I mean, these are rational people. They may be political, they may be adversarial, I recognize that, but they are rational. These are not crazy people. And so you put it in a game theoretic context. This is a classic negative-sum game, which means that if they don't reach an agreement, both sides are worse off. Clearly, the European Union and the Eurozone will be worse off. If Greece does leave the euro, I don't expect that, just to be clear, but if they did, that would be catastrophic. I mean, it's hard to sort of know what the ripple effects would be, but certainly there would be, certainly you would see Podemos sweep to power in Spain. You might see the National Front, Le Pen, gain significantly, maybe even become president of France, if you can imagine that. Similar parties would arise in Italy. They're already there, but they would gain power. There would be a domino effect. People would expect, Portugal and then Spain and then Italy and possibly Ireland to quit the euro. The euro would literally fall apart very quickly with unforeseeable consequences in terms of target 2 balances, declining asset values, global financial catastrophe. That would be the beginning of that. Okay, so there's your downside. Pretty bad. This isn't just a shoving match between Germany and Greece. This is catastrophic on the one hand. On the other hand, let's imagine you're Greece. It's not a lot of fun either. So you actually want to quit the euro? Okay, that's fine. Now you're back to the drachma, which is barely worth the paper you printed on. You've already admitted your government is bankrupt as a negotiating posture, so now you're going to come out with your own currency, not backed by anything. By the way, their gold, their 100 tons of gold is pledged to the ECB to secure the prior bailout they got, so that now they have no gold, a bankrupt country, and a paper currency nobody wants, and everyone's running for the exits. Good luck with that. So my point being, if they fail to reach a settlement, there are disastrous consequences for Greece and disastrous consequences for Europe. That's the ultimate negative-sum game, which means that in behavioral game theoretic space, they're going to reach an agreement. Now, one of the questions I get most frequently is who's going to blink and who's going to blink first? And the answer is they're both going to blink. Both sides will give more than they want. Both sides will not be totally happy with the outcome. But an outcome is an outcome, and if there's some agreement, both sides will walk away saying, I got part of what they want. You can count on the Germans to emphasize what little sliver that they managed to get. You can count on the Greeks to emphasize whatever sliver they got. Maybe Greece will get a little more than Germany this time around, but they will find a way. And the short-term deadline is the end of this month. Now, the significance of the end of February, that's when the existing bailout has its next tranche. And the way they've been doing this is the Troika, European Central Bank, the EU, and the IMF have been dispensing money to Greece in exchange for which Greece agrees to adhere to an austerity program, which so far they have been in terms of raising taxes, cutting expenses, reducing public payrolls, cutting deficits, privatization. There's just a whole long list of things that they've agreed to do. And they have been living up to their end, not very happily, and that's why Syriza was able to sweep to power. Now, what Syriza said is that we are not going to adhere to the program any longer. And the Troika said, well, if you don't, we're not going to dispense any more aid. So you have this train wreck set up for the end of the month. But there is a way out, which is this idea of the bridge loan. The bridge loan would be new money with no strings attached or very few strings attached for 30 days or maybe 60 days. So, and the idea there would be to buy time to rework the fundamental agreement. So it would not be a continuation of the existing bailout. That would very possibly be over at the end of February. The two sides would then get to work on negotiating a new long-term solution with some concessions in favor of Greece. And to give you, 30 or 60 days to do that, they'd need some kind of bridge loan. Who would the lender be? Remains to be seen, but very unlikely to be the ECB. Could actually be the IMF, or it could be Brussels. They've been very creative. You know, the EU, they've been very creative at coming up with emergency facilities. So what I look for is a game of chicken between now and the end of the month, increasing tensions, increasing volatility, lots of bad headlines, lots for the Brexit groupies to, you know, cheer about, but some kind of last-minute bridge loan probably coming from Brussels, 60 days of hardball negotiations, and then finally a new settlement, and Greece remains in the euro. That's my expectation. That's what I would advise investors. But I would also say that, you know, like I say, expect volatility and bad headlines and bad days in the meantime. I think I'm right for the reasons I mentioned, but if I'm wrong, I'll go way the other way and say that the catastrophic consequences of that are actually worse than the worst skeptics have imagined. And that's why I think they'll find a way. It's precisely because I can envision a worse catastrophe than the critics that my expectation is we won't go there, because both sides, I think, understand how bad it can be.
Well, then finally, the Ukraine crisis. So what's striking here to me is that maybe a growing rift between Europe and the United States. We see Angela Merkel and her European colleagues apparently negotiating an effective surrender of the eastern Ukraine provinces to Russia, and the U.S., meanwhile, is talking up lethal aid to Kiev. Where will this one end?
Well, surrender is an interesting word. I think the technical term, John, I think you're kind of right in pointing in that direction. The technical term for it is fait accompli, which is that's a Latin phrase which means I win. In other words, Putin just took what he wanted, and no one's going to do anything about it, so it's a fait accompli, and he wins. And then the question is, how do you accommodate that? How do you fit that within, you know, your understanding of the world order, and how do you learn to live with it, like it or not? And I think your first point is a very powerful one, which is that there is a wedge driven between Europe and the United States, and that goes back to my first point about the lack of U.S. leadership. Now, last Wednesday morning, I was in Washington meeting behind closed doors with a group of national security professionals, and we had, there are about 15 of us. We have what we call Chatham House rules, which means that you're not allowed to mention names of individuals, and you're not allowed to give quotes attributed to individuals, and I want to respect those rules, but you are allowed to talk about it in general terms. You just can't say, you know, Mr. Jones said this or Mr. Smith said that. So I'll honor those rules, but just to give the listeners a flavor, we had U.S. ambassadors, CIA covert operatives, people from Treasury, people from National Security Council, people from think tanks. So it was a pretty high-level group. I was listening. You know, I try to be polite, but sometimes I can't help myself. But I was listening for a while, and the tenor of the conversation was sort of, what does Putin want? You know, we need to figure out what Putin wants. Does Putin want this or Putin want that? And we need to know what Putin wants so we can figure out how to affect his behavior, et cetera, et cetera. And at some point I just interjected. I said, this is ridiculous. This is the worst example of what in intelligence analysis we call mirror imaging. Mirror imaging is a flaw in intelligence analysis, and it arises when the analyst assumes the other guy thinks the way you do. In other words, the West looks at Putin, assumes Putin thinks the way we do, and then says, well, what does the guy want? And once we figure that out, we'll know how to change his behavior in certain ways, etc. And I said, first of all, Putin doesn't think the way we do. So get that through your heads. Number two, and that's where the mirror imaging comes in. Get away from the mirror imaging. Understand he's a different breed of cat. He thinks about things very differently. Number two, asking what Putin wants is the easiest question in the world. I know what Putin wants. He wants Georgia. He wants Ukraine. And then when he gets those two things, he'll figure out what's next, probably Moldova and a few other places. So he's on a tear in terms of territorial expansion. It's easy to figure out what Putin wants. The hard question is, what does the United States want? This is where our leadership and our foreign policy have fallen down. We have no strategy. We have no well-articulated set of goals. And as Henry Kissinger says, you know, it's important to know what you want. It's also important to know what you don't want. In other words, you should have a list of things you will not allow. Is Russian occupation, in effect, or of eastern Ukraine and Crimea something that we will not allow? Yes or no? Well, if the answer is yes, then you got a war on your hands and you got to go for the throat. If the answer is no, then live with it. But the point is, we're not asking those kinds of thoughtful questions, the kind that Kissinger was very good at framing. We're not asking that. This, as far as I can see, the White House, and forget the State Department, to some extent, forget the Defense Department. I mean, I've never seen an administration where more policy is concentrated in the White House than we have today. And very powerful departments like Defense and State, and for that matter, the intelligence community, end up being peripheral players because there's so much power concentrated in the White House, in the West Wing. And these people are amateurs. I mean, I don't know what to say, but, there's nothing wrong with being younger. I'm all for getting younger people around, but the problem with being younger is you're young. I mean, you don't have the seasoning that you get from, George Shultz or Henry Kissinger or Madeleine Albright. I mean, it's not a partisan comment. They're strong players on the Democratic. Too bad Richard Holbrooke died, at a young age. He would have been one of the people you could turn to in a situation like this on the Democratic side, and there's certainly a few people on the Republican side. So it's not a partisan comment. It's just that it's amateur hour at the White House. They've centralized power. They're micromanaging. They don't know what they're doing, and they just go from day to day, headline to headline, spin to spin, and say, well, what feels good today? What looks good today? But none of it's thought through. No one's asking questions about what U.S. interests really are, what we will permit, what we will not permit, how we will align goals with resources and capabilities. So this is a massive, massive problem. But the result is that Putin is getting what he wants, and the Western response is a muddle, just to kind of bring the conversation back to economic space. I mean, Europe does not want these sanctions on Russia. They are the eighth largest economy in the world. They are a major trading partner to Europe. They do provide, depending on the country, anywhere from 90 to 30% of energy imports of all the major countries in Europe. So this is not a peripheral player that you can push around. It's not even like Iran. Iran's a pretty big country, but not that heavily integrated into the global economy in ways that you have to worry about. But Russia is, and so Europe doesn't want the sanctions. Obama does. You got a lot of hawks, and by the way, it's not just the Democrats. You got Republican hawks, McCain, Lindsey Graham, and others who are banging the drum over this. But none of them, as far as I can tell, have really thought it through. So what I see is a lack of U.S. leadership, a lack of U.S. strategy. Putin is focused like a laser beam. He knows what he wants. And then people say, is there a potential for war here? And my answer is, we're in a war. We just that, unfortunately, a lot of our leadership don't realize it. And this is what I said to a group of experts on Wednesday, because they were talking about economic sanctions as a form of diplomacy and an alternative to warfare. And I said, no, economic sanctions are warfare. It may be non-kinetic. I mean, you're not shooting and dropping bombs necessarily. It's non-kinetic, but it's not diplomacy, it's warfare. The alternative to economic sanctions is diplomacy. And this is what Merkel is saying. And I think that message got through to Obama based on what I've seen about their meeting today. I mean, Merkel has said clearly there is no military solution in Ukraine, and she's right. Well, that means you have to have a diplomatic solution. But the White House still thinks that sanctions are a form of diplomacy. But what I'm saying, and the way Putin looks at it, sanctions are a form of warfare. And it's a warfare that risks escalation. What's the equivalent of a thermonuclear bomb in economic sanctions? Well, the answer is kicking you out of the SWIFT system. SWIFT is the Society for Worldwide Funds Transfers, and based in Brussels. That's the messaging system. That's the central nervous system for the entire global financial system. They process $6 trillion a day of interbank transfers, message traffic between the banks. Well, kicking Russia out of SWIFT would paralyze their economy. That's the equivalent of dropping an H-bomb on Moscow. And Dmitry Medvedev, the president of Russia, said the other day, if that happens, the Russian response will know no limits. And those are his exact words, no limits. Well, no limits means the Russians can escalate up to and including a nuclear response. That's how we're kind of playing with fire here. And I think, as far as I can tell, Merkel did a pretty good job of sort of getting through to Obama that economic sanctions were counterproductive. We're either in a war or close to a war. We need diplomacy, and diplomacy at this point means Putin gets a lot of what he wants. Now maybe we'll circle back and punch him in the nose somewhere else in the world. It's funny, well, again, I can't attribute specific quotes to specific people, but I'll just say the view is expressed that Putin is wondering why we're not doing, sabotage somewhere because He's used to that. He's just not used to these sanctions, and that's the people in the White House think it's a good way to put pressure, but it doesn't put pressure. I mean, again, the mirror imaging comes in the following way, because these people in the White House who are pretty naive, as far as I can tell, say, you know, let's put pressure on the oligarchs, and the oligarchs will put pressure on Putin, and we'll change his behavior. That's the analysis. Well, it works in reverse. You know, if you put the screws to, if you had a way to put the screws to Bill Gates, Warren Buffett, and a couple hedge fund kings, I dare say they would find a way to get through the White House and get the White House to change their behavior. That's the way it works in our system. It's not the way it works in Russia. You can put pressure on oligarchs. That's easy. But if the oligarchs put pressure on Putin, he'll put a bullet in their heads. You know, Obama's not going to assassinate Warren Buffett. He'll probably do what Warren Buffett wants. But Putin will see to it that an oligarch gets assassinated. So there's an asymmetry. This is where the mirror imaging falls down. So this whole naive idea that you can put pressure on Putin via the oligarchs is nonsense. But hopefully we're waking up to that, and it does look like Putin's getting most of what he wants, but hopefully that war will die down. But I think it's going to take a while. We'll have some more, as I say, we'll have more bad days on Greece. We'll have more bad days on Ukraine before this is all over.
Let me just follow this briefly with a question that came up between colleagues. In everything you've described, do you feel that the hazard of a kinetic war between NATO and Russia is any more likely or less likely? Or is it a concern for you, that possibility?
It's a concern. It's certainly more likely. I don't think it's going to happen, but if you said, you know, we're kind of dialing it up from 0 to 10, well, we got way past 5 last week and maybe even up to 7 or 8 because, you know, and again, this all happened when I just happened to be in Washington for this meeting, but over the course of Monday and Tuesday, the White House leaked to the New York Times that they were considering arming Kiev, you know, Kiev being the Western Ukrainian forces. They were considering providing lethal aid. I mean, right now they're giving them body armor and, you know, sort of defensive stuff, but they would actually give them some more heavy weapons. And then Wednesday morning, Agence France reported that Poland had agreed to sell weapons to Ukraine. And interestingly, they were going to sell them, not give them, but I guess the Poles need the money, so that's understandable. So all of a sudden, you've got Russia arming rebels in the east and the U.S. arming Kiev forces in the west. And now you have a proxy war between the U.S. and Russia. That would be a proxy kinetic war. I mean, as I said, the financial war is already here. Cyber war is already here. But this would be kinetic. You'd have everything short of U.S. troops or NATO troops confronting Russian troops, but you would come very, very close to that with, in effect, NATO arms confronting Russian arms, and I dare say Russian troops. I think there are Russian troops in eastern Ukraine. So you could have the specter of Russian Spetsnaz, which are their special forces, being killed with NATO weapons. How does that feel? Not so good. So we were really barreling in that direction as of last Wednesday. Now here it is Monday. There were talks over the weekend. The U.S. seems to have backed off on that a little bit. I mean, Merkel is the only adult supervision. This is like a playground. You know, Putin's kind of out there, very difficult. Well, difficult for some people to understand. It's easy for me to understand because he's kind of a thug and a killer, and he feels that he's been dissed. Just to put it in the language of the basketball court, you know, we dissed Putin. I mean, think about what Obama has said about Putin publicly. He said Putin is like the kid who sits in the back of the class and wiggles and doesn't pay attention. Notice he's like the dumb kid or the kid with the ADD in class. I mean, here's the President of the United States calling the Prime Minister of Russia a kid in the back of the class who's too bright, right? So that's, and then, you know, and then on and on. I mean, how is that a way to run a bilateral relationship? How is that a way to create dialogue? How is that a way to engage in diplomacy when you're publicly insulting the head of state of the 8th largest economy and one of the major thermonuclear powers in the world? So this again shows you the amateurish nature of Obama's foreign policy. I think that probably as late as Wednesday or Thursday, John, to answer your question, we had dialed it up to maybe 8 on a scale of 10. And I think as of today, it's dialed back down to maybe a 5 or a 6. So that's good news. But this was a game of chicken played by people who didn't really understand how chicken ends.
Well, I'm very mindful of people with us wanting to ask you questions, but we call this series the Gold Chronicles, and I feel like I really have to ask you briefly about gold, which is, in a way, through all this drama, has behaved, I would have thought, quite undramatically. I mean, it's bounced up and down a little bit in the dollar price, but there's been no spectacular swings. It's as if gold is, as a sort of market intelligence, is not reacting very intensely to all these huge upheavals we've been discussing. What's your take on that?
Well, John, I mean, you're absolutely right in terms of the price action. It took a beating last fall, and then it picked itself up and got up off the bottom and traded up, around the $1,300 range. Just backed off from that, but it does seem to be holding most of those gains, most of that retracement from the lows, and that's a very, very positive sign given what's going on around the world, particularly given the strong dollar. Now, a couple of comments on gold. One of the most, and in my book, The Death of Money, I talk about this in Chapter 9. I also talk about this a lot in my newsletter, my monthly newsletter, Strategic Intelligence. I discussed this quite a bit. But, gold, I say gold is money, but I recognize the fact that it trades like a commodity. So, it trades on commodity exchanges. People treat it like a commodity. It has some inflation insurance aspects to it. So, I get that. But I try hard to think about gold as money. It helps me to understand what's going on. Well, if you look at a chart of gold and a chart of commodity indices that include gold, but along with a lot of other things, so iron ore, copper, aluminum, other agricultural commodities, other commodities, what you see is a very high degree of correlation with a downward trend through most of 2014. But right around the end of 2014, right in the kind of November, December time frame, they completely diverged. The commodity index plunges, mainly because of the oil price class, which we all know about, but gold starts to go up from that, kind of trading off those 1,100 lows up closer to $1,300. When I see a very sharp divergence like that, the high correlation between gold and broader commodity indices suddenly breaks down and the commodity indices continue to collapse, but gold goes up, which it did, that tells me that gold is now trading like money. In other words, it stopped trading like a commodity and started trading like money. People just wanted it, independent of what was happening to deflation and commodity prices and other things. That happened, by the way, right around the same time that there were large outflows from the Federal Reserve Bank of New York. Again, I think the listeners, this is a very sophisticated audience we have on this call. I think listeners are aware of the repatriation movement, the movement to get your gold back. That's also something I talk about in my newsletter, Strategic Intelligence, but also talked about that in the opening pages of Currency Wars, my first book in 2011. I was the first one to say, hey, Europeans, Japanese, all you people, you got your gold at the Federal Reserve Bank of New York. Don't be surprised if the U.S. seizes your gold in some kind of future financial crisis. We have a good track record of seizing assets when we feel like it. I remember I sent that book to a good friend of mine who's a PhD economist, and it's actually on, I think, page 3, even in the 3 little I, in the forward or the introduction, where I said this was a possibility that we could seize all the European gold. And my friend said to me, he said, Jim, I read that. He said, if I didn't know the book was written by you, I would have thrown it in the trash right there. That was such a ridiculous comment. I almost stopped in my tracks, but I knew it was by you, and I kept going and read the whole book. And so we had kind of a laugh about that. Well, guess what? I mean, since then, the world has woken up to the threat. The Germans are getting the gold back. The Dutch are getting their gold back. There was a referendum in Switzerland, which unfortunately failed because the Swiss National Bank lied to the people about the peg. But if they lie to you once, shame on them. If they lie to you twice, shame on you. So maybe the Swiss people will wake up the next time. But this, there's talk about in France and Belgium and elsewhere. So this movement is alive and well. But those shipments out of the Federal Reserve, they reached a peak right around, for the year, right around November, December 2014. They're continuing. So I've got these 2 data points. Major shipments of physical gold coming out of the Federal Reserve in November, December 2014, and a sharp divergence between the price of gold, the dollar price of gold, and the gold index right around the same time. I look at those 2 things, and it tells me that what's going on is that the scramble for gold is now thinking of gold not as a commodity, not as an investment, but as money, which I think is the right way to think about it. I've gone a step further, John, in my thinking, which is the whole thesis that China's acquiring gold, Russia's acquiring gold. At a minimum, this will this will be your pile of poker chips in the game of Texas Hold'em the next time they reset the international monetary system. Could you possibly have a gold-backed currency? I don't necessarily predict that, but it gives you an option. There's price suppression going on to keep the price low while these two countries back up the truck and get all they can. There's a diminution in the floating supply, which is different than the total supply. So we've talked about all those things before. I'm sure we'll talk about them again. But I've gone a step further, and this is starting to look like a corner. And I don't want to put a stake in the ground on that. I need to do more work and need to think about it a little more. But it's starting to look like a corner to me. There's never been a successful corner of the gold market. There was the famous one attempted September 26, 1869 by Big Jim Fisk and Jim Gold on the old New York Gold Exchange. There was certainly an attempted corner and a panic, but then the corner was broken by President Grant and the Treasury agreeing to release some gold. Of course, a lot of listeners are familiar with the Hunt brothers' effort to corner the silver market in 1980. That was busted by two things. First of all, they got pretty far along. The price of silver spiked up. But you had two phenomena. You had every grandmother in America climbing up to her attic and getting up the family silver and selling it to door-to-door salesmen who were going around door-to-door. And, of course, in the precious metal industry, that's called scrap. It may be a nice silver set, but whether it's flatware or bracelets or necklaces or whatever, that kind of scrap silver literally came out of the woodwork and flooded the market, so suddenly there was a lot more floating supply. And of course the government changed the rules, although a lot of people whined about that. My view is get over it, that there was a rule that says they can change the rules, so you should see that coming in, and change the margin requirements and bust at the corner. So the Hunt brothers got caught between Granny and the government, and that failed. So usually these corners fail, but Russia and China are different. First of all, the scrap has been coming out of the woodwork already, independent, without a price spike. Our conversations with refiners in Switzerland, they've said they've had trouble sourcing scrap. And there's a little "We Buy Gold" sign in every corner of America. People like at CNBC like to make fun of that as if somehow diminishes the role of gold, but I remind them those signs don't say "we sell gold," they say "we buy gold." So a lot of the scrap has been hoovered up, and refiners are having trouble sourcing it. So I think the grannies have already done their thing, and the government can't do their thing because Russia and China are sovereign governments who don't care what the CFTC thinks or the commodity exchange. So they're kind of immune to what happened to the Hunt brothers, and they're probably have a little more resources than Big Jim Fisk from the 1860s. So it could be a corner. I don't want to predict that, but it is something I'm watching very closely. But another reason to own gold.
Well, that's interesting. Thanks, Jim. I'm going to turn quickly to Alex, hoping we have time for at least one or two questions from our listeners. My apologies to everyone. We really needed, as I think you hear, to cover a lot of ground in this conversation. Alex, over to you.
Okay, thanks, John, and thanks, Jim. We have about, 8 minutes left, and we're going to do our best to answer a couple of questions here. As per usual, what happens when we do these webinars, we have way more questions than we have time available to answer, and I was just thinking a little bit ago about maybe what we should do as a webinar where it's only Q&A with Jim, because we could easily fill an entire hour because the questions just keep coming and coming. They're very good questions that are in the queue. I apologize, we're not going to be able to answer them all. Some of them are very smart questions, and they come from a wide range of people. I have one here from a 25-year-old university-educated geologist who is underemployed, all the way up to managers of substantial funds that we have on the call as well. So we're going to try and tackle two here. The first one, this comes from a gentleman, I believe, by the name of Arthur, and his question is, how do you view holdings in a fully allocated physical gold trust like Sprott's?
Well, here's the thing. I've always, obviously I recommend to investors that they have something in gold. And I've been pretty consistent that 10% is the right amount. Some individuals have more. That's a choice for the portfolio manager or the individual. But if you look at institutional allocations on the whole, they're actually closer to 1%. So there's a lot of headroom between where people are or where institutions are and where they think they need to get to. And if you don't like 10%, then do 5%, but have some significant allocation to gold. Now, that said, I do recommend physical bullion, not paper gold. Paper gold would be COMEX futures, ETFs, unallocated forward contracts, and LBNA members. I think all those are very flawed ways to hold gold, because what you really want at the end of the day is wealth preservation and price exposure and they're going to give it to you up until the day that gold spikes out of control. Then they're going to terminate your contracts as of the close of business on the prior day. They're going to send you a check. They're not going to steal your money, but you're going to get a check for yesterday's close, but you're not going to get today's price action, because that's the thing that will break the bank. So you need physical gold. Now the question is, how do you hold it? It all depends on, you're talking about 5 coins, or are you talking about 100 million allocation out of $1 billion portfolio? Well, when you get into those large amounts, you do need structures, and one of the things that I've always liked about the physical gold fund is that, and I've seen a lot of these, and believe me, I get shown, offering documents and org charts and things like that on many of them, and I've always liked the physical gold fund because it's very well thought out, from Swiss vaults to even the really technical things like keeping the gold inside the LBMA network, and by network I mean there's a whole approved list of refineries, secure logistics providers, right down to who's driving the armored car, where's the vault. I don't want to get too in the weeds on that, but there's a lot to know there, and Physical Gold Fund has thought through all that, so I like it. Now, there are others out there. Sprott's a good name. I can't say I've done the diligence on Sprott the way I've done on the Physical Gold Fund, but as far as I'm concerned, any reputable firm that's offering physical gold fully allocated with the ability to get the gold if you want it, if you call them up and say, I'd like to redeem my units and I'd like the gold shipped to the following destination, it could be a private vault or any designated custodian, then that's a good structure. So again, I caution investors, do your own due diligence, talk to your lawyers and accountants, read the documents carefully, understand what it is you're getting, but all gold investments are not created equal. Again, I'm comfortable with the Physical Gold Fund because I've done the diligence there and spent time with that, but there could be other good ones out there as well.
Okay, very good. This next question comes from a gentleman by the name of Joseph. He is a managing partner in what looks like a fund management company. His question is, or what he's saying here is, I hear you loud and clear about the reasons to hold gold in a portfolio, and I own some in physical form. But I own far more physical silver than I do in gold. Given the historical role that silver as money has played, why do you emphasize the role of gold so resoundly and rarely mention the investment merits of silver? Are there attributes to silver that make it less valuable money?
Yeah, the answer is I'm not a silver basher or a silver hater. I think silver has a role to play. I have some silver in my portfolio. Here's what I would say. Silver is always going to tag along with gold. There's no way that gold's going to $5,000, $6,000, $7,000 an ounce, which I do expect. And silver doesn't go to 100 or 150 or whatever some rough equivalent is. So if gold takes off, silver's going to take off with it. It's not going to be left in the dust. And therefore, it's a good holding. The only reason I don't talk about silver a lot is because gold actually isn't good for anything except money. Money is a pretty good thing to have when the world's falling apart, so I like gold for that reason. But gold has very limited industrial uses. Yeah, it's used for jewelry, but I consider jewelry wearable wealth. People talk about getting a new watch from Apple. They call it wearable technology. Well, to me, gold is wearable wealth. You can put a nice necklace on, a bracelet, or if you're a woman, a pair of earrings or whatever, and of course, that is what they do in India. You see these women adorned in gold. Well, that's their bank account. They're just walking around with it or wearing it to the wedding ceremony, as the case may be. So I don't really separate jewelry from wealth. Gold is a store of wealth, even though I think the World Gold Council probably does treat it separately. But if you treat jewelry as just a form of wealth, really no different than bullion or bars and coins, then gold has no industrial uses. Silver does. Silver is good for a lot of things, a lot of industrial inputs, which means it's always going to move on two vectors. One is the monetary vector, but the other one is the industrial vector, and they can be pointing in different directions. The monetary vector could be pointing up if there's a flight to quality or an outbreak of inflation, or just on a fear trade, but the industrial vector could be pointing down. There's a slowing global economy and less demand for silver as an industrial input. So to me, it's a mixed bag, and I don't hold myself out as an expert on all the industrial applications of silver. I know they're there, and to me, it just muddles the picture a little bit. So I'm not anti-silver. I'm not a silver basher. I think it does have a place in the portfolio. I just don't spend as much time on it because I'm a global macro analyst, not an industrial engineer. So I'll leave it at that.
Okay, perfect. Now, normally we would be turning this back over to John so that we could wrap this up, but there is one last question that I want to try and squeeze in here, and we may run just a couple of minutes over time, so I apologize for that, but it's a really good question. And this question is coming from Sasha. I'm going to briefly read what she wrote in an email. She says, as I asked this, I'm a 25-year-old university-educated geologist and underemployed. I have no mass wealth to protect by the purchase of gold, although I do own a few bars. However, I have not seen any benefit from the supposed growth. I think what she's talking about is what's parroted in the MSM and by the current administration, from my family and friends, just the creep up in asset prices and the costs of living. Will there come a time in the near future where the honest work of individuals will be enough to purchase a home, raise a family, and enjoy the quality of life where one needs not worry about how to merely survive from day to day? And I guess the summary of it is, will a real and equitable economic expansion take place after the fall of the dollar and the restructuring that you've written and talked about, Jim?
Here's hoping we can get to the kind of growth Sasha is asking about without a collapse in the international monetary system. My views on that are based on the trends I see, the instability I see, a lot of dysfunctional public policy, a lot of misapprehension of the statistical properties of risk by the Fed and other policymakers. So that's why I warn about that. But, I hope I'm wrong. I hope it doesn't happen. But right now we are on track for that to happen. Unfortunately, if it does happen, there are sort of two possible outcomes. One is, it serves as a massive wake-up call. We sort of, maybe like Noah after the flood, the waters go down, we land the ark, we get out, and we start over again. And maybe that restart is a much healthier kind of economic dynamic with the kind of opportunities Sasha is talking about. So that's one possibility, but it's not the only one. The other one is a much darker vision of a neo-fascist response as financial institutions collapse, as money riots break out, as things go from bad to worse. Governments, as they always do, they don't go down without a fight, and they respond using, militarized police, surveillance. I pointed out that people like the convenience of Easy Pass, but you have to remind people that every Easy Pass toll booth in America is a surveillance interdiction point where they're using facial recognition software, license plate scanning, operating on government orders. You can be seized and detained if you think government isn't politicized, just like what the IRS did to the Tea Party. So that's the dark side of what's going on. I hope we don't get there. What I hope is that myself and others, acting as a wake-up call, working through the electoral process and an educational process over time, can lead us to some better policies. And by the way, for Sasha and actually all the listeners, and Alex, at the risk of sort of throwing in another promotional link here, but I'm going to do a debate. It's actually live on Broadway Wednesday night at 6:30. The sponsor is a group called Intelligence Squared. That's really all you need to know. Just Google Intelligence Squared. You'll find the link quickly, or I'll put it out on my Twitter feed. But the event's sold out, but they're going to live stream it. But the proposition, this is an Oxford Union-style debate, so nobody's going to interrupt anybody. No one's going to scream at each other. Hopefully we'll have four thoughtful people who stand up and make their points. But the proposition is, declinists be damned, bet on America. So it's a pro-American proposition. And the people arguing for are Yosef Yaffe, a very prominent intellectual, and Peter Zeihan, who had a long career at Stratfor. And arguing against are myself and Chrystia Freeland, who's a rising star in the Liberal Party in Canada, member of Parliament, and very prominent journalist and public intellectual. So we're going to have some good firepower on the stage, and if you want to find that link and live stream it, we're going to be talking about exactly the kind of thing that Sasha and maybe some of the other listeners are interested in, which is what is the future of America.
Okay, very good. Thank you very much, Jim. And with that, I'm going to turn it back over to John to wrap it up.
Well, thank you, Alex, and thank you, Jim Ricketts, for a really illuminating conversation today. It's been great being with you. And thank you to, most of all, to our listeners, and for some really phenomenal questions. As Alex says, I know there's a whole lot of other great questions in the pipeline, and I think we will need to find a way to really address those, and we'll discuss that and figure something out. You can follow Jim Ricketts, as you know, on Twitter. His handle is @JamesG.Ricketts, and look out for that debate. It sounds extraordinary. Intelligence Squared was the phrase to Google. And talking of which, Jim mentioned his newsletter, Strategic Intelligence. It's very affordable and a great way to follow Jim's in-depth thinking month by month. If you just Google Strategic Intelligence Jim Ricketts, you'll find it easily enough. One final note, You can find recordings of all these Gold Chronicles webinars with Jim Rickards online. And the way to do that is to visit the website physicalgoldfund.com/podcasts and register for updates. So thank you for staying with us over time today. Hope you found it fruitful. Goodbye for now, and we look forward to joining you again soon.